What I wanted to get was perspective. If you eliminate the mortgage interest deduction, what does that do to the housing market?
I'm going to knock that right back at you. One of the parts of the gig of running a government-controlled company is you don't say things about government policy discussions. So the reality is I'm not supposed to answer that question.
Fair enough, because you don't want to seem like you're lobbying the current bill.
Right.
But historically, I know for me personally, the mortgage interest deduction is a very big deal and very helpful in my home and being able to afford it. Can you give us perspective on what the mortgage interest deduction did for the housing market?
A classic economist will tell you at the margin, cutting the mortgage interest deduction will slightly cut the demand for housing. It has been so long since we didn't have it or it wasn't a factor, no one's got any good data to really predict. It's sort of structured guessing. So the answer is nobody really knows that well.
And on the flip side, the story is, well, that's okay because we're going to get lower taxes so people will have more money so they can go buy a house. Do lower taxes, personal taxes, wind up helping when you want to purchase a house?
Absolutely. Just no one knows exactly how much.
Gotcha. But taking a look at the business in general, how would you categorize the housing market now?
The housing market now is very healthy in one sense and maybe not so healthy in another. House prices have been going up nicely for several years, higher than the rate of growth of incomes, household incomes. Unfortunately, that makes it harder for a first-time home buyer. And on the rental side, it means rents go up more than incomes. The underlying issue here is, and people are recognizing this more and more, there's not enough production of new houses in America. Without getting fancy about growth rates, the average production of new housing units in America averaged for many years about 1.5 million units, single family and rental. Dropped off in the financial crisis, obviously. Not only has it not made up the drop off, it has never returned to 1.5 million. We are not producing enough houses, which is providing a great price support to the houses that exist, but it's making it tough for people to afford rents and buy new homes.
Yeah. This is happening everywhere, it seems. This is happening in the United Kingdom. Home ownership rates are just rolling over. Why do you think this phenomenon has taken place, and who's doing it right now?
Well, this is not about home ownership rates. This is about any housing, rental or single family is just not enough. The issue of the mix of ownership versus rental, I haven't worried about non-US for a while. This job is very domestic. But the causes, there's lots of anecdotal evidence. Everything from taste going more urban, and urban means more rental. It's later family formation. People get married later, they have kids later. They take that, I need a house. All these things have rolled into a lower home ownership rate, as well as all the economic things you know about. So
to Freddie Mac specifically, you guys raised the limit of how much of its credit risk transfer securities can be bought by sovereign funds, pension funds, example. So basically more private investors can buy those. What's demand?
Credit risk transfer is kind of the biggest thing since sliced bread in the GSE world in the long run. The biggest defect of the GSE system is these two companies sitting on $5 trillion of credit risk in one asset class. That's not generally very healthy. I'll say it's an accident waiting to happen, except it's happened twice. This time with the GSEs collapsing, and back in the late 80s, of course, that concentration in the thrifts caused the thrift crisis. So the whole long-run game plan is to do more and more credit risk transfer, diversify it through the markets. What we did recently was introduce a new type of credit risk transfer vehicle that can produce more risk transfer for longer periods, and more investors are eligible to buy it. So there's more demand, and we could put stuff out in a larger size. And the one thing about running a GSE, you deal in size. Our transaction was credit risk on about a little over $1 billion of mortgages, and that's just a starter transaction.
We're all talking about the new Fed chair, Don. The old Fed chair, the one before Janet Yellen, Ben Bernanke, when he left, the story was that he went to get a mortgage and he couldn't get one. Credit-worthy borrowers right now, are they able to get the mortgages they should be able to get?
I'd say generally yes. Between the two GSEs, between FHA, you're familiar with them, who do more marginal credit loans, although I hope Bernanke was not one of those.
I would hope so, for your sake.
And the banks lending off their own balance sheet, mortgages are getting made to broadly consistent people who are creditworthy. His problem, as you found out, you see, he just changed the job. He didn't have much job history.
I love that. You're like, I don't know about your income right now,
Yes.
Mr. Bernanke. All right, Don, great to see you. Thank you very much.
Great,
Don Layton,
thanks.
Freddie Mac, CEO.